Okay, so you want to own a high-end car dealership. You have seen the showrooms with the polished marble floors and the Ferraris rotating on turntables behind glass. You have watched the salespeople close deals on vehicles that cost more than most people's houses. You have heard the numbers, a single Lamborghini sale, a single Bentley transaction, and somewhere in the back of your mind, you have been doing the math. Here's the problem. The math most people are doing is wrong. Not slightly wrong, completely wrong. Because what you see from the outside of a luxury dealership, the gleaming inventory, the effortless looking transactions, the lifestyle the brand projects, has almost nothing to do with what the business actually looks like from the inside. And the gap between those two pictures is where most new owners lose everything. Before we talk about money, we need to agree on what kind of business we are actually discussing. Because high-end car dealership is not one thing. It is at least 5 completely different business models operating under the same roof, each with a different cost structure, a different risk exposure, and a different way of generating revenue. The first model is a franchise new car dealership. This is a business that holds a formal franchise agreement with a manufacturer, Porsche, Mercedes-Benz, Aston Martin, and sells that manufacturer's vehicles under their terms, their pricing guidelines, and their facility standards. The second model is an independent pre-owned luxury dealer. No franchise agreement, no manufacturer oversight, no allocation system. You buy used inventory at auction or from private sellers, you recondition it, and you sell it at a margin. The third model is a consignment operation, where the vehicles are not owned by the dealership at all. Owners bring in their cars, you sell them on behalf of the owner, and you collect a flat fee or a percentage at closing. The fourth model is a dealer group, meaning a single ownership entity that controls multiple franchise rooftops across different brands. The fifth model is a hybrid operation, blending new franchise sales with a large certified pre-owned inventory and a standalone finance and insurance department. These 5 models share a zip code on the luxury tier, but they have almost nothing in common financially. Most people who say they want to own a high-end dealership are picturing the franchised model, the Porsche store, the McLaren showroom. So that is where this begins. But by the end of this, you will understand why the franchise agreement that looks like a golden ticket is also the most expensive set of handcuffs a dealer owner ever puts on. When a luxury vehicle sells, the money does not move cleanly from buyer to dealership. It splinters across an ecosystem of institutions before the dealer sees a net profit figure. Take a transaction on a new Porsche 911 at $145,000, which is a realistic entry-level price in the current market. The moment that sale closes, the dealership does not pocket $145,000. It pays the manufacturer's invoice price, which on a vehicle like this sits at roughly 92 to 94% of MSRP. That alone leaves a front-end gross of somewhere between $8,700 and $11,600 before a single expense is deducted. Then the floor plan interest charge arrives. Floor plan financing is the loan a dealership carries to fund the physical inventory sitting on the lot. On a $145,000 vehicle financed at current commercial rates, carrying that car for 45 days costs the dealership approximately $900 to $1,200 in interest. That comes directly off the front-end gross. Then come the fixed costs allocated against each transaction. Technician pre-delivery inspection fees, detailing labor, dealer preparation charges, and documentation processing together remove another $800 to $1,500 per vehicle. By the time those layers are stripped away, the dealership's front-end profit on a $145,000 Porsche is often between $4,000 and $7,000. On a $500 toaster, those margins would be unacceptable. On a 6-figure vehicle, most people on the outside assume the number is 10 times larger. It is not. The front-end margin on new luxury vehicles is structurally thin, and it has compressed steadily over the past decade as online pricing transparency eliminated the negotiation room that used to pad those numbers significantly. Now here is what it actually costs to open this business. Franchise acquisition is the first and largest barrier. To obtain a franchise dealership point from a premium manufacturer, a buyer must first identify a point that is available, which in established markets is rare. Porsche, Ferrari, and Lamborghini franchise points in major metropolitan areas trade as business assets entirely separate from real estate and inventory. A Porsche dealership in a top-tier market can carry a blue-sky value, meaning the value of the franchise rights themselves, of $5 to $20 million before a single vehicle or square foot of real estate is factored in. Ferrari and McLaren points in cities like Miami, Los Angeles, or New York have traded at multiples significantly above that range. This is money spent on permission to do business. It generates no inventory, no building, and no equipment. After the franchise acquisition, the facility requirements begin. Manufacturers at the ultra-premium tier impose strict facility standards called image programs. These dictate the architecture, interior finishes, lighting systems, display platforms, customer lounge specifications, and even the materials used on service bay floors. A compliant Aston Martin or Bentley facility in a major American market typically requires a build-out investment of $8 to $25 million, depending on location and square footage requirements. These are not suggestions, they are contractual conditions. Failure to meet image standards can result in franchise termination. After facility costs come inventory capitalization. A luxury franchise dealer must maintain a minimum stock level specified by the manufacturer. For a mid-volume brand like Porsche at a regional rooftop, that can mean carrying 40 to 80 new vehicles at any given time. At an average transaction price of $120,000, the inventory line alone represents $4.8 to $9.6 million in floored assets generating daily interest charges. Add pre-owned certified inventory, loaner vehicles, and vehicles in service reconditioning, and the total inventory exposure for a legitimate luxury operation regularly exceeds $15 million. Total capitalization to open a single compliant franchised luxury dealership in a competitive American market, when you add franchise blue sky, facility costs, inventory floor plan, working capital reserves, staffing, technology systems, and regulatory compliance, runs between $20 million and $60 million. That is the real number. Not the number in the article about the dealership's grand opening. The actual capital requirement that separates viable operators from people who enter underfunded and exit quietly 18 months later. The businesses that fail at this level do not fail because the market for luxury vehicles disappeared. They fail because they did not enter with enough capital to survive the gap between their first monthly expense and their first profitable quarter. Not because the business model was wrong, because they did not enter with enough capital. The revenue side of this business is where most outside observers are genuinely surprised, and not in the direction they expect. There are 4 primary revenue streams inside a luxury dealership, and only one of them is the car sale itself. New vehicle sales generate front-end gross, as described, and also manufacturer incentive income. Manufacturers pay dealers bonuses called holdback and dealer cash that are tied to volume targets, customer satisfaction scores, and certification compliance. On a Porsche transaction, holdback returns roughly 2% of MSRP to the dealer after the vehicle sells. On a $145,000 sale, that is $2,900 arriving weeks after the transaction closes. For a dealer hitting volume bonuses, manufacturer incentive income can add $500,000 to $2 million annually on top of front-end gross. Finance and insurance is the second revenue stream, and in many dealerships, it is the most profitable per transaction. When a customer finances a luxury vehicle through the dealership, the dealer earns a reserve on the interest rate spread. On a $120,000 vehicle financed at a marked-up rate over 60 months, the dealer's finance reserve can reach $3,000 to $6,000 on that single deal. Extended warranty products, gap insurance, and paint protection packages sold through the finance office add another $1,500 to $4,000 per transaction. A high-performing finance and insurance manager at a luxury store can generate $6,000 to $10,000 per vehicle in total back-end profit. The service department is the third stream, and it is where the most stable and defensible income lives. A luxury vehicle generates significantly more service revenue per year than a mainstream vehicle because maintenance intervals are shorter, parts are expensive, and labor rates at brand-authorized service centers are high. A Porsche dealership with 400 active service customers billing an average of $3,200 per customer per year generates $1.28 million in service revenue, largely independent of whether any new cars are selling. In a market downturn, when new vehicle sales collapse, a well-developed service department keeps the business alive. Beyond these core streams, pre-owned vehicle operations add a fourth layer. A luxury dealer buying trade-ins and auction vehicles, reconditioning them, and reselling them as certified pre-owned can generate front-end grosses of $8,000 to $20,000 per vehicle, significantly higher than the new car margin, precisely because there is no manufacturer invoice constraining the pricing. Let us trace exactly what the math looks like across a single month of operations at a mid-volume luxury franchise. The dealership sells 25 new vehicles at an average front-end gross of $6,500. That is $162,500. That is $162,500 in new vehicle front-end gross. Manufacturer holdback and volume incentives on those 25 units add approximately $90,000, arriving 30 to 60 days later. Finance and insurance back-end profit on the same 25 deals, assuming a per-vehicle average of $7,000, generates $175,000. The service department processes 180 repair orders at an average ticket of $1,400, producing $252,000 in service revenue at a department gross margin of approximately 65%, meaning $163,800 in service gross profit. Pre-owned operations sell 15 certified vehicles at an average gross of $11,000, adding $165,000. Total gross profit across all departments for the month sits at approximately $756,300. Against that, the fixed overhead structure for a compliant luxury facility includes facility lease or debt service of $180,000 to $250,000 monthly, floor plan interest on the full inventory line of $85,000 to $140,000, compensation for 60 to 90 employees totaling $380,000 to $520,000, manufacturer advertising assessments, technology systems, compliance audits, and insurance adding another $60,000 to $90,000. Net operating income, when the math resolves, sits between $0 and $100,000 in a normal month. Some months it is negative. There is a persistent belief that ultra-luxury brands, the Ferraris, the Bugattis, the Rolls-Royces, are the most profitable dealerships to own because the vehicles cost the most. The reality is structurally more complicated. Ferrari strictly limits the number of units allocated to each dealer annually. A Ferrari dealer in a major market might receive 40 to 80 new vehicle allocations per year regardless of demand. That artificial scarcity protects the brand's exclusivity and resale values, but it caps the dealer's revenue ceiling at exactly the point where volume would otherwise begin generating operating leverage. Rolls-Royce and Bentley operate similarly. The manufacturers that generate the highest dealer profits at scale are not the ultra-exclusives, they are the premium volume brands, Porsche, Mercedes-Benz AMG, BMW M, where allocation volumes are large enough to drive service department growth, finance and insurance volume, and manufacturer incentive income simultaneously. The pre-owned independent model removes the franchise cost entirely, but it introduces a different category of risk. Without a manufacturer's certified pre-owned program behind the inventory, buyer trust is harder to establish. Without a captive service department generating recurring revenue, the income stream is purely transactional. Without manufacturer holdback or incentive programs, every dollar of profit must come from the vehicle margin alone. Independent luxury dealers succeed when they develop a specific inventory niche: low-mileage exotics, one-owner European imports, factory option collector vehicles, and build a buyer network around it. The operators who fail in the independent model are the ones who buy at auction without disciplined pricing. Discipline, recondition without cost control, and then hold aging inventory while floor plan interest accumulates daily against vehicles that are not selling. The economics of this business ultimately reward operators who understand that a luxury car dealership is not a car business. It is a financial services business, a real estate business, and a customer retention business that happens to display automobiles in a glass showroom. The vehicle is the entry point. The service relationship, the finance product, the trade cycle that brings the same customer back every 3 years. Those are the actual revenue engine. Dealerships that focus entirely on the transaction, the front-end gross on a single sale, consistently underperform against operators who measure revenue per customer over a 10-year relationship. A customer who buys 4 vehicles from the same dealership over a decade, services each one exclusively at that facility, and refers 2 additional buyers generates somewhere between $80,000 and $160,000 in lifetime gross profit to the business. That customer acquisition and retention system is what separates the dealerships that compound value year over year from the ones that grind through inventory and wonder why the margins keep shrinking.